Good morning, traders and investors. My name is Roger Scott. I'm the head strategist for WealthPress. Today is February 3rd. Where is 2021 going? Let's start off with the opening market. We're going to be opening in about an hour and 8 minutes. Markets are mixed. The Dow Jones is a little lighter. The Nasdaq is up almost 100 points. The S&P is up a little bit, and the Russell is down. Folks, welcome to Deep into what we call earnings season. And this Friday, I'll give you another update of where we stand. But so far, numbers are in line, maybe a little bit better than expected. So far, things are okay. Now, in terms of the broad market, we are now above the Dow Jones for the second session. If today we close above the 50-day moving average like yesterday, without touching any part of the 50-day moving average, I will become bullish again. But till that happens, I am neutral, especially in light of the fact that this is momentum levels. This is the S&P 500, and this is the number of stocks in the S&P out of the 500 stocks, how many are trading above the 200-day moving average. So this is how many stocks are bullish. And I wanted to show you a 10-year chart. Look at the level we're at right now. 88% of stocks out of 500, about 400 stocks, out of 500 are trading above the 200-day moving average, which over time is overly bullish. This yellow line represents the last time that happened. Look at that. Look at that time. This is April 2011. We were at this level. You could see it for yourself. I'm not making this up. This is not a conspiracy. And the NASDAQ 100, where there's 100 stocks, we're at 91st percentile, which means we are at the highest level we've been. Let's see, that's 10 years. Let's go 20 years. Jeez, we're now going all the way here, which is 2009. So in the S&P 500, momentum hasn't been this high in 10 years or 9 years, give or take. And in the NASDAQ 100, we're talking all the way September 2009. I mean, we're talking over 11 years. So we are in nosebleed territory. We've got to be very, very cautious because the market is in what we call a stretched out mode. Now, we're talking about the 200-day moving average, not the 50-day moving average. So the sentiment may take a while to change, but I'm telling you right now, markets cannot sustain these levels for too long. And now, if you're a swing trader, it's not going to be that big of a deal because the 200-day is more of a position trade indicator. But I'm telling you right now, for the purpose of positioning yourself in the market for the next 3 to 6 months, we are going to have some hiccups. We just can't sustain these levels. The market can't be running at a sustained rubber band stretched out level forever. So that's going to catch up to us. And I'm telling you, it will catch up to us. Now, as far as global economy, let's go through the global news. Wednesday, investors bet on eventual approval of relatively big versions of Biden's pandemic relief bill. That's what's driving the market right now, folks. But for this, the market would be in a crapper right now. And I mean a crapper. And you wouldn't be seeing this, and you wouldn't be seeing this. You would be seeing these levels around the 40th percentile. And I'm not even sure if these levels can forestall the inevitable. And markets have a way of doing what is inevitable. Democrats, Republicans remain far apart on support for President Biden's $1.9 trillion stimulus package. That's not good. Shares of GameStop and AMC started plunging, and I told you they would. As a matter of fact, why don't we take a quick look at how they're doing pre-open? Might as well, right? Ooh, 89. I told you this was going to happen. This thing is going to go down to 20 or to the teens. AMC, let's see. Yeah, it isn't faring that well. It went all the way from 20 to 8, and I'm telling you, this sucker's going to go to about 6, maybe even lower. And there's a couple of other stocks that I'm fairly bearish on that are in that ballpark. These are the ones I predicted last week would go down. Let me just go through these real quick. KOSS. Oh, yeah. It was at 60. I put a target of $3 on it last week. Now it's already at 20. Next one was IRBT. Let's see. I put a target of 85 on it. It was at 125. It's moving down. And here is EXPR. I put a target of, it was at 4. I put a target of $1. It's now at 3.30. They're all dropping, and they're all dropping pretty fast. So I don't think this fad is going to last very long. You don't want to buy short squeezes. You want to fade them after the fact. So now, let me talk about the two stocks that are on the table right now. Again, I am very with this market right now. It can go either way, and it's vulnerable. It is vulnerable, folks. So if you look at the 10 major sectors, you will see that financial and energy are still leading. And healthcare is all the way down here. Healthcare is not doing that great, and it should be coming up, but it's not. And we've got a couple of stocks that were really doing well last year that are coming down. The first stock is Humana. Humana is a healthcare stock. And this is the 200-day moving average. I figured I'll make it purple today. Well, why not, right? So again, usually it's this ugly mustard colored. I don't know why. Let's shake it up a bit. So it's trading below the 200-day moving average. This is a 9-month chart. If you look at a 2-year chart, you will see that the stock is breaking major support, which is right here, but this is pretty far enough since it's below the 200-day line. The bottom line is this stock can go all the way to the 280 level, to the 250 level. It can go all the way down to this level right here, 300 level, and it wouldn't be that big of a deal because the stock is kind of overpriced and it's been making lower highs and it's trading below the 200-day moving average. Next stock, Church & Dwight. What did they do? Arm & Hammer, soap, deodorant, cleaning products. Just doesn't, looks like markets are discounting the COVID, and it looks like we're looking ahead and we're trading below the 200-day moving average finally. Remember all those stocks trading above the 200-day moving average in the S&P? Well, these two are not part of it. You want to find the 10% that's not, and those are the stocks. When this thing cools off, these stocks will be the first to run down. So Church & Dwight makes Arm & Hammer. Again, notice the price is coming down. It's breaking multi-month support. It hasn't been here since 10/29, since my birthday actually. So it's been several months now. It's breaking lower. If you look further, the stock it is actually breaking support level, and there's no major support for this stock till like the 79 level, and then you don't really have anything till the 77 level. And folks, I am telling you this because it's just, you can't sustain these levels. And right now you've got 88% of stocks trading above the 200-day moving average, 12%, so about 100 are trading below. And those stocks trading below the 200-day moving average, when this thing pops lower, are going to be the first to go down. Remember, the weaker stocks go down faster. The strongest stocks hold on to the most they can. And these stocks are weak right now because they are in position of trading below the 200-day moving average, lower highs, below the 200-day moving average, and breaking multi-month support. Lower highs, breaking the moving average, trading at the lowest level we've seen since the summer. So I am telling you, Humana and HUM and CHD may not be the stocks you want to be in if you are long. And if you're thinking of hedging yourself, which is not a bad idea with the market being at nosebleed levels like this, you may want to hedge yourself by increasing your short position by initiating these shorts. So if you have a long portfolio and the market cools off, you will hedge yourself by offsetting some of that risk. Now, just in case you haven't noticed yet, the markets can be heavily influenced by the richest people in the world. They can pour millions of dollars into seemingly random stocks and send the share prices to the moon. And I mean to the moon. Take Peloton, for example. A lot of people wanted to do with this stock when it dropped to 18. They wanted nothing to do with it. But then George Soros came in flying and bought 2.7 million shares of it, and the stock shot up to $140 overnight. Overnight, literally. I mean, it did it fast. I mean, it didn't do it overnight, but it did it fast. I mean, it did it like that. These billionaire kingmakers, as I like to call them, can completely change the outlook of a stock. And those that manage to get in on these stocks before the billionaires drive the price up could cash in big. Big. Luckily, stock market expert Adam Sarhan seems to have figured out how to make that happen. Adam knows his stuff. Click on the link below to learn how you can create a kingdom with your profits in 2021. And make sure you like this video, subscribe to the Wealth Press channel if you're watching it on YouTube, stay ahead of the markets by being the first to be notified when we post the next video, and post comments for me. I love to hear your comments. Bye, guys. Have a great midweek. Bye.